The United States Mint has made a move that few could have imagined. After decades of operating smoothly, producing silver coins for collectors and investors alike, it has halted all silver sales. To the casual observer, it might look like a minor operational pause, a simple adjustment, but the truth is far more profound. For 50 years, the financial system taught us to believe that silver's price lived on a screen in New York. Algorithms, futures contracts, and paper derivatives dictated the market. Physical silver was irrelevant, or so we were told. But today, reality has spoken. The Mint's suspension signals that the bureaucracy cannot keep up with market volatility. Rising prices have outrun their capacity to source metal. This is no technical glitch. It is a sovereign-level scarcity warning, the first visible fracture in decades of price suppression. The United States government, the entity responsible for producing constitutional coinage, has admitted it cannot deliver physical silver at market rates. This is the moment where illusion meets reality. The Mint's doors are closed, and with them, the first signal of systemic stress. Paper markets can spin stories, but when the physical supply cannot be met, the market speaks a new language, one of scarcity, urgency, and fear. While the Mint freezes its operations, the private market reacts instantly. Dealers such as JM Bullion, SD Bullion, and AppEmps suddenly find themselves unable to meet retail demand. Premiums spike as available silver dwindles. For the first time in years, the retail market experiences a full-scale freeze. Imagine trying to buy a silver eagle, only to find that every dealer is rationing inventory. The shelves are technically stocked, but no one can purchase. The effect is psychological as much as physical. Scarcity drives perceived value, and the public's desire for silver surges. Every ounce held in vaults becomes precious. Every contract unfilled on the COMEX becomes a story of deferred fulfillment. The closure of the Mint is more than a supply issue. It is a message to the market. The government recognizes silver is now too valuable to sell at the old prices. Retail investors, who once trusted the paper price, now face the harsh reality that physical possession is power. As retail investors panic, a far more significant story unfolds behind the scenes. Strategic entities, whether sovereign funds, industrial conglomerates, or massive trading houses, are quietly withdrawing millions of ounces from the largest U.S. vaults. In a single day, over 1.3 million ounces were pulled from J.P. Morgan, the supposed fortress of silver. Additional withdrawals occurred at Brink's, CNT, and Loomis vaults, totaling nearly 1.8 million ounces in 24 hours. These are physical movements, not paper transfers. Metal is leaving the system. The implications are staggering. The COMEX, which has long been the center of paper-silver trading, is losing its inventory to entities that understand the value of physical possession. Eligible silver, the type typically held for storage, is moving in mass quantities. The message is unmistakable. The smartest players in the market are no longer willing to leave their wealth in paper-based systems. This is the West's first warning. The real silver is leaving the country, and the retail investor is left fighting for scraps. The reason behind this exodus is crystal clear when we examine the global market. In China, silver is trading at $98–100 per ounce. Compare that to the COMEX price of $89.67, and an $11 arbitrage gap appears. This gap is not a minor inefficiency. It is a vacuum pulling physical silver eastward. For every contract purchased in New York, a bar of silver can be shipped to Shanghai for an immediate, guaranteed profit. The Mint and U.S. dealers are outbid daily. The result? Silver is flowing uphill to the highest bidder. Paper prices in the West have become irrelevant. The market is dictated not by algorithms, but by real physical demand, industrial requirements, and strategic hoarding in Asia. Every ounce that leaves the vaults is a warning. The Western market is losing control, and the East is rewriting the rules. Physical silver now sets its own price, and the gap between paper and reality will continue to widen until the COMEX adjusts or until the vaults are emptied entirely. Its $100 per ounce is more than a number. It is a psychological barrier. For decades, silver was undervalued, the poor man's gold, lingering in the $20s to $30 and $30s. The market believed silver could not reach $100. That belief is now obsolete. When the Mint suspended sales, it sent a signal that scarcity is real. Scarcity fuels urgency, urgency fuels panic, and panic fuels exponential demand. Once headlines break of $100 silver, public perception will shift instantly. Retail investors, fearing further shortages, will chase ounces at any cost. $100 is not a ceiling. It is the ignition point of the mania phase. The rising price validates scarcity, scarcity validates the price, and the loop feeds itself. Every coin withheld, every ounce shipped east, adds fuel to the fire. Physical demand is taking control, and the market will react accordingly. Gold sits at $4,616 per ounce. The gold-to-silver ratio is around 51,000, one far from the historical 15,001 equilibrium. If silver returns to its natural ratio against gold, the price could exceed $300 per ounce. Meanwhile, industrial demand accelerates scarcity. Solar panels, batteries, and green technology require silver in large quantities. Strategic players are hoarding physical ounces, leaving paper contracts as hollow promises. The West is losing control. The East dictates physical pricing while the COMEX and New York exchanges attempt to catch up. Every day that passes without the mint reopening widens the gap between paper and physical, accelerating the inevitable. Silver is no longer a speculative asset. It is a strategic store of wealth. The mint is closed. Vaults are emptying. Paper prices are illusions. The market is transitioning from perception to reality. Wealth is moving from those trusting fiat to those holding silver. Investors face a choice: hold physical silver or risk being left behind. Private vaults and personal possession are now critical. $100 per ounce is the starting line, not the finish. Mania is beginning, and the rules of the game have changed forever. The West underestimated scarcity, the East controls demand, and paper markets are powerless against the physical reality. The silver revolution has begun, and only those who hold real metal will benefit from the coming surge.